industry matures, I assume it's going to start looking like regular way funds, meaning cross promotes and fee structures that create alignment and the types of bells and whistles that investors would expect in regular way real estate funds.
Yeah.
So I don't know that we're quite there yet, but presumably sponsors, tier one sponsors at least, are not going to accept getting paid their promote at the back end 10 years. That's not going to fly. So folks are going to have to figure out a way to crystallize that promote through an artificial waterfall at the end of the performance of the investment, and then reset capital accounts or create a distribution for the sponsor. And if we can do that, which I think is where we're headed, then this is just a 10-year fund, and there's most of the Odyssey Index core funds are have long horizons. I mean, it's gonna be very similar to a regular way fund. But I think folks have to expect, investors are going to expect normal bells and whistles to create alignment, and sponsors are going to expect to be able to get their promote off the table before year 10.
Well, how about Carlos? To add to that, I mean, we're typically looking at 5 to 7 year olds, on average, and target IRRs net to the investor north of 15 on those, but that entails the capital gains hit that you're investing with, and then also that back end to, let's say if it's a 5 year, then you're taking those capital gains, reinvesting in another one of our deals, and then year 10, on the second, will be the second deal, you're getting hit again. So at the end, you're looking at, what would be a 12 IRR under these benefits that our investor on a 10-year hold would be looking at, and we have a lot of patient capital that investors, so we're happy staying in the deal that 10 years, that's the meat of the benefit, right? That's what we want to hit for the most of the funds. There is going to be refi potential, for some of the deals that we can explore, and then, but the majority we're trying to look at a 10-year, just lowering the IRR expectation because of the benefits and structuring the promote in a way that, we can still hit, a decent size despite the reduced or the longer term time period. And I think that there's also opportunity. You were talking about the 70-30 bad assets versus good assets in the OZB, and in the fund level, the 90-10. And there's opportunity for value and value creation in those in that 30% and in that 10% of the QOF level that you can explore during your fund process to also make additional, higher returns. And I think it's all about getting creative and obviously getting the right advice, because it gets complicated, and we have a situation with the ground lease and an existing asset, and we're having the QOF buy the shell and then ground lease the property, and how does that work? And obviously there's a lot of mental gymnastics, but there's value to be gained if you're willing to dig into that. There's different ways that you can get there still by holding the asset 10 years and still achieve value for both, but it is more complicated.
Okay, I'd like to take a couple minutes. Dan is here. He's got 3 projects, ongoing and Opportunity Zone, and give us a little bit of a sense or feedback or discussion of what it's like to be in the middle of one of these things from a development standpoint.
Sure. The first project is the block, and it's well positioned in a unique opportunity zone. It's located on the Salt River Pima Indian Reservation, adjacent to Scottsdale. And this project, actually being an Indian ground lease, gives you a lot of flexibility with related parties and things. So we like that. Also has a very low basis. Our ground lease is low. It just so happened we were kind of committed to this trade area anyways, and then we woke up one morning and our governor designated this a zone. So we're here to understand how that type of capital works with our projects. There's 3 projects that abut right up against Scottsdale that happen to be on an Indian reservation and opportunity zone. It's about $258 million development pipeline. One project's under construction right now. The next one starts in September, and the third project, which is a Class A office, 500,000 foot campus, will begin construction sometime in 2020. These are all mixed-use projects. They have different components to them, but we're excited about this type of capital. We think that it may help us bring in better capital, better equity, but also we're trying to balance that against how does this affect our timelines. And obviously, if we do accept this capital, it's a big commitment to preserve this tax treatment for your investors. It creates challenges. I think one of the things to Carlos's point, though, is when you do this and you plan to hold something for 10 years in it, you end up doing better deals. This prevents a lot of merchant developers from coming in and working in this space. It's a lot easier to make a return when you sell it at a cap rate. If it's under construction, this means that you have to do a good job and create the yields necessary to carry the debt service and pay all your costs. I think from that perspective, this is a good thing. I think that hold period forces the industry to make better deals.
Okay. We've got a couple minutes here. Do people have questions? We'll go ahead and take any of those. If we've been so clear that we've answered every question. Yeah, go ahead. I'm sorry.
I'd like to hear your position on applying opportunity funds in the case of municipal government properties, capital project properties. As we know that a lot of municipalities go to market, they use some sort of bond offering. Would you recommend applying opportunity funds, combining that with a public utility or public project?
Any feelings on P3 partnerships, combining opportunity zone funds with either other benefits, either governmental financing, enterprise zones, new markets, tax credits? Anybody had any feelings one way or another? Like life isn't hard enough with those programs? You want to make it? You want to hit yourself with a hammer in the head a few times?
There's different programs out there. There's tax credit, federal tax credits. There's employment tax credits. My understanding is that you can layer these programs, so that may be a benefit. I don't think by developing an opportunity zone and taking this type of capital prevents you from exercising those other benefits that you could, just like any other project.
Yeah, we currently are for our first seeded deal in Wilmington, and we're continuing to do so. I'm not sure I fully understood the
Well,
question.
what I'm saying is, in some instances, municipalities issue revenue bonds, and sometimes they use the bond exemption status to raise money as a debt finance. So I'm just wondering whether or not it would be a good combination with an opportunity fund.
For the municipalities, yeah, I'm not sure.
I don't see any tax issue with using taxes and bonds. But the advisability from a developer's perspective got me.
Thank you.
Yeah. Thank you. Oh, over here.
Yeah, hi. I have two questions, one for Dan, one for Carlos. Dan, what makes the attributes of that zone so intriguing to you, and are there any differences between that and some of the other zones that you may have looked at and invested in?
Yeah, that's a really good question. There's a lot of opportunity zones out there, and you can go and search these zones for well-positioned opportunities. I think that, like any development opportunity, you have to kind of find the needle in the haystack. There's zones that have qualities that other zones don't. A zone may be a zone but right next to Scottsdale, for instance, where you have, if you stand on this side of the road, it's $115,000 household incomes and 250,000 people and 150,000 employees. And if you stand on this side of the road, it's $30,000 household incomes. And it just so happens that these intersect in this unique area, and we positioned our investments, right on that border. There's other zones that have very low residential but very high employment because of the tests that the qualifiers that these zones need to hit. Sometimes a high employment area or dense employment area without a lot of residential can qualify. And some of these governors that designate the zones want to move capital into these areas. So you got to find the well-positioned real estate within these zones, or the well-positioned zones within those markets. I think that's critical.
Okay, and lastly, one short question for Carlos. As you're looking at hospitality opportunities, is it just pure investment, capital allocation, or are you indifferent if management is already captured by the developer?
Sorry, I missed that last part. Can you repeat that?
if management is already captured by a developer, is that something that your group looks for in terms of an investment opportunity, or is it just capital allocation for the hospitality?
It's just capital allocation for the hospitality.
Okay, great, thank you.
Yes. My name is Greg Bond, and I'm from Orlando, Florida. We have a kind of a unique situation where we assembled several lots for an assisted living facility. Half of those lots were pre-2018, and half of those lots were after 2018. And we're just wondering structure-wise how to deal with that type of situation where we've got half of our property pre, half of our property post.
So where's the property now? How's it owned?
It's currently owned in separate land trusts.
And it's outside of any kind of a fund structure currently?
Yes, that's correct.
So if you can, and there's nothing on it right now, it's
There's
just
nothing
land.
on
So if you could do a financeable ground lease, you should be able to move it in.
Okay. Because we've got all the rezoning done. We're right at the point of starting to raise capital. And we went, wait a minute, it's an opportunity zone.
A financeable, I don't know, 65, 70-year ground lease. You know, it's easy for me to say that because I'm a tax lawyer and I don't have to deal with the lender, right? So, but that seems to be the tool to deal with that situation.
Okay. Thank you.